Hello, financial institution students. We are now approaching week 4. So again, this course goes so quickly. I find that with all these types of courses, but everyone's doing a good job to stay on top of things. And this week, you get a little bit of a break. Consider it spring break. I get a spring break from my work at MCC Longview. Still be doing work, but it's not nice not to have to respond to any emails or as many emails, I should say. So anyway, um, so enjoy the break, but take this time to start thinking about your final project, your company, your bank analysis paper. I put out there in this week, I'd just like you to post which bank that you're planning to analyze and research. Again, I'd go with a bank that's publicly traded so you can find information. Probably larger banks could be a little bit better to get more information about things that are going on in the news, etc. But I've also posted some links out there this week for the Federal Reserve. This would be a week, to maybe just pick an article at random, just read it, kind of touch base with it to tie into the material because there's some interesting stuff out there, especially for the 10 magazine. Or if you want to learn a little bit more details about the Fed, you'll read about it this week, and I'll tell you briefly about it here in just a little bit. But anyway, I hope everybody's doing well. Hope you have a great week. Happy Spring Forward Day. And I heard that the stimulus checks will start arriving March 17th. So that's going to be a big injection in the economy. In fact, it will impact reserves, the bank balance sheets, all that inflow of cash quickly. So it'll be interesting to see how quickly that money is spent. Um, how much is saved, how is actually purchased on consumer goods, and how it has like a wealth effect, if you will. That's the thing, kind of being cautious about thinking about these mental buckets in your head. Remember, this is just a temporary injection, but it will help a lot of people. And it has debate with it too. It's going to be some long run cost at some point. Somebody's going to have to pay for it. It will probably be my kids that have to end up paying for it in the long run, and that potentially could mean less consumption for them in the future. But the idea is our former Federal Reserve Chairman Janet Yellen, who's now Treasury Secretary, is stressing, and Jerome Powell, our current Federal Reserve Chairman, is trying to get the economy back on track. And I think that's one of the reasons the markets, financial markets, the stock markets have been doing so well, is pricing that information in. So we'll have to wait and see how that pans out with the vaccinations and all that. But we potentially could be on a pretty good recovery here if everything falls into place. So, okay. So first, Chapter 9, the central bank, the Fed. You're going to look at the history of that, the structure. The Federal Reserve Bank of New York has a kind of unique position that they are always on that rotating open market, the Federal Open Market Operations Committee. There's always 5 banks. Our local president, Esther George, will rotate on that every once in a while. It's traded off among the other Federal Reserve presidents, and then you have board members that are appointed by the president. But the Federal Reserve, to me, historically, was first brought about as a central bank, partly because of instability in the nation's banking system, different crises, and also just the fact that J.P. Pierpont had to bail out the U.S. economy by himself one time. I think the United States government at that point said, we're never going to depend on one man to bail us out again. It was a situation where the stock market was about ready to close because they didn't have enough liquidity and cash. And he was able to pull in a lot of money and convince other big bankers that you got to keep the market open, because if the market closes and there's no willing buyer, the whole system shuts down. It would be he recognized it would be chaos. So that's where the central bank was established shortly after in 1913. So it's been around 100 plus years. But some of the main objectives of a central bank is supervision or regulation of banks. We saw a lot more of that after, especially the subprime crisis. Help assist with the nation's payment system, check clearing, not so much. It used to be big. A lot of people used to write checks. There's still checks, but a lot of it's done electronically now, and it presented where you actually used to have physical checks. I remember going to see it at the Fed, and the Kansas City branch did a lot of it. They would do a lot of the processing, but mostly it's through electronic transfer now. A Fed wire that they do that if you want to exchange monies between someone in Arizona and Missouri. And then they also do a lot of economic research, and that's why I just encourage you to get a chance this week. Pick out an article Just kind of read it even regionally, or kind of seeing the Fed's thinking, and they have so much research out there. That's one of the gigs that economists go work for the Fed for a while, and then they maybe go to the private sector or go teach. But yeah, I think you might find that interesting. So, main objectives of the Fed, I would say, is price stability. That's the big one. In other indirect ways, they're trying to provide growth and employment. And they mostly do that through the monetary policy. That is the buying and selling of treasuries on the open market. But there's other tools that the Fed has too. And you're going to read about those things. This readings this week about the discount rate and also reserve requirements. So, but other central banks. Europe, Japan, England. You're going to read a little bit about those. It was kind of interesting, especially with the European Union in the Maastricht Treaty. I can remember reading about this when I was in graduate school, about '92, and then it came to fruition by about 2000 that we saw the common currency with the euro. One of the most challenging difficulties that the European Union has is in the United States we're all, although we're 50 different states, we're all within the United States. We have similar cultures. Speak the same language, but in Europe you don't. So there's always going to be that burden in trying to implement monetary policy where you might have one country really struggling and another country doing really well. So that's what they have to kind of balance. But I think in theory, and that's where we saw some of the rumbling with the Brexit recently, that they never really converted to the euro. They kept the pound. But the idea was that by having a common currency and common rules, and a common monetary policy, they could come like the largest economy in the world, if you will. And by exchanging more goods and services with fewer rate transaction cost, you could actually boost employment and stability in a region. So, okay. So some other things you're reading about. Most of the readings in chapter 10. That's kind of where the little bit more technical reason, but you're going to look at the details of how that's done by our Fed and the central bank of using reserves. They talk about the terms non-borrowed reserves, and also those in terms of borrowed reserves. So not non-borrowed reserves, you think of the open market operations, kind of they show this vertical line, and then borrowed reserves are this horizontal line. So you're going to look at different examples about different actions that the Fed takes. If they're doing an open market purchase, or if they're doing sells, the purchase is going to increase the reserves, pump up the money supply, push down interest rates, and sells are going to lower the reserves, decrease the available supply of money, and that's going to cause the contraction. So, but right now, they've been pretty much doing like a expansionary monetary policy nonstop for many years. It was kind of stopped a little bit. We started to see short-term rates starting to go up before COVID hit, and then they went back down to zero again. So some other things I just want to point out. Some of the things they can do. They can do dynamic changes that they want to kind of really shift. Target interest rate to defensive, try to keep it in line. And the Fed funds rate is really the rate that banks charge other banks to borrow overnight. Every 2 weeks they have this thing called Settlement Wednesday where they have to kind of make sure that the commercial banks are meeting that reserve requirements. Right now, I looked it up yesterday, and the reserve requirements from banks are, if you're over 127.5 million, you got to keep 10% on reserve. Between 16.9 and 127.53%. But the Fed uses the tools of open market operations. There's their primary one. They could also use the discount rate to try to influence monetary policy and changing the reserve requirements, but they really don't do that. And the discount rate is there to be a lender of last resort. It's a rate higher than the trading in the Fed funds rate. The Fed funds rate is banks borrowing among each other. So when I was a Fed funds trader at a central credit union, we had excess reserves, so we were trying to sell those at a rate. At least my job was to sell it at a rate highly higher than the average Fed funds rate. And basically, it's just overnight loans. And right now, that rate is really, really low. So, okay. Um, and you just mentioned a few more things about the discount window. There's primary credit. Overnight for healthy banks, secondary credit, those that are more in maybe banks that are in a little bit of trouble, and seasonal credit, you often see that like agricultural, and they will sell that like at so many basis points above the Fed funds rate. Some more alternative kind of policies the Fed can use that you'll read about is quantitative easing, where they're starting to buy long-term Treasury bonds, mortgage-backed securities. Really, as you kind of the idea of bonds, you think of that again, if I'm driving up the price and pushing interest rates down. So, especially after the subprime crisis, they were doing a lot of that to keep long-term rates low too, to try to stimulate the economy. They can do such things as, they did discount window, expanded lending, TAF loans, lending to Wall Street was one after the subprime crisis, which was kind of controversial. But they recognize that if we don't do something, the whole system is going to collapse. Some other terms you read about is credit easing, kind of the idea, altering the Fed's balance sheets through open market operations. Forward guidance, kind of keeping interest rates at zero. That's what we're kind of doing now. And even there's negative interest rates, which Japan did, that you actually charge banks to keep money at the Fed. So when you're reading about this chapter, there's required reserves and then there's excess reserves. But banks have to keep reserves with the Federal Reserve Bank or in vault cash, and a lot of them keep the banks at the reserves to help them with transaction costs. So I'll wrap up with that, and the main thing, kind of just say that there are critics of the Fed. You'll read about that in the asset bubble crisis, subprime. Did they do enough things or did they not do enough things? They didn't recognize that markets were acting irrational and that perhaps they should have intervened. But I would argue that Ben Bernanke did the right thing after the subprime crisis to eventually get us back. So even though the stock market crashed at that time to all very lows, actually if you had bought in the market, you would have more than recovered it based on what the rate of returns are today. And maybe there's some question of today, is the market overvalued? There probably are some securities that are overvalued, but it's kind of a question, if you're really for investing, you're in it for the long run. So there might be some correction here. But I've always said if you stick with the S&P 500 fund over the long run, you're going to beat most professionals. So that's it for this week. So I hope you have a little bit of a break. And if you have any questions, do email me. But make sure you wrap up everything from tonight, 30/14/2021, for your assignments due tonight. And I'll get those graded pretty quickly. So take care and send me an email if you have questions.